now. By this I mean that we will have probably some countries which will have left, and the most obvious candidate is Greece at some stage. They will have to leave if they want to have a new start of their own country. Portugal might be another country. Even Italy might at some stage think about leaving the euro. It's not something which I'm forecasting, but I'm just saying those are countries which are candidate for a euro exit at some stage. And the euro will be much more integrated. This is the other thing we will see, meaning we will have probably by then a banking union. We will have probably by then a sort of federal state of Europe or a sort of United State of Europe, something like this. And I'm also betting that Britain will be outside of Europe by then. Thank you very much.
Well, let me ask the first panel to come down and bring your name plates with you, and we'll get settled in. And what a wonderful opening. Just really a profound and good overview of what is happening with Europe. Here for the audience is what we'll be doing. The first panel is about trade, exports and imports, both ways. And we're going to have 6 people. Each will offer 1 or 2 points, very brief 2-3 minute points, about trade and how it's transpiring. You have their bios, so rather than take time to introduce them at great length, they're all very distinguished. I'll just refer to their affiliations. So if they're all settled in, we're going to hear first from Elizabeth Schaefer. Elizabeth has come in from Washington to be with us. She's with the U.S. Department of Commerce, and she's going to offer an overview, give you the statistical lay of the land about trade with some focus on our region of Greater Cincinnati. So Elizabeth, thanks for being with us. The floor is yours. Yeah, and you can do it from your seat. Yeah, that's fine.
Good morning. Thank you. Good morning. Again, thank you for having me. I'm very happy to be here. So as you've already heard about the macroeconomic forecast of the current European crisis, there are movements towards improvement, but we still see quite a bit of potential slow growth in the EU, particularly the IMF World Economic Outlook. In last fall, I think they projected the EU at 0.5% growth for 2013. So that is a little bit slower. And thinking about what that potentially means for the business community here in Greater Cincinnati area, there's a lot of potential variables. So instead of focusing on the macro, what we decided to do is put together some Cincinnati International Trade Metro export data statistics. So if you take nothing away, basically from this presentation, please take away that Cincinnati is actually doing pretty well over time and has increased its overall export to the rest of the world since 2005. So that's from 2005 to 2011, if you can't see in the back, with $18.7 billion in merchandise shipment exports in that year. With the exception of 2009, which was the economic Great Recession, it's been steadily increasing over the last 6 years. The red bar in the bottom is the exports going to the EU. So that's about $5.7 billion per annum in 2011, and that's about 34% of the overall exports leaving the Cincinnati greater metropolitan statistical area. Looking at that breakdown in 2011, the $18.7 billion number, 46% of that is transportation equipment. That's $8.6 billion with a smaller breakdown in chemicals, machinery, and some paper and computer and electric products. As far as where the destinations are for that $18.7 billion, a lot of that is the NAFTA countries, Canada and Mexico, 10% going to the UK, and a large percent going to France, although that number is suppressed by the census for different business confidentiality reasons. But France is one of the top 5 export destinations for Cincinnati exporters. And then finally, because there's so much information that we have just released that's published, our next slide, which I'm told will be distributed to all the members today, has more information about how Cincinnati compares relative to other export areas. Cincinnati is rated 16th out of the top 50 metropolitan export areas nationally in 2011, and it's been performing very well in the Indiana, Kentucky, Ohio area. If you go to the Metro database, which is included, you can slice and dice according to your relevant sector. I know that we just covered merchandise exports today, but we also have different information on services exports and different applicable areas for the greater Cincinnati area. Thank you.
So very optimistic, good growth, and we stack up well generally.
Yes,
so
performing very well.
We can pat ourselves on the back for a minute there. That's very good. And our next speaker will give us kind of a banking perspective here, Brian Cobb with U.S. Bank. Brian, your thoughts?
Everybody hear me okay? There we go. You know, from a banking standpoint, I'm with the international group of U.S. Bank, and typically what we get involved in is helping our clients mitigate foreign country and foreign bank risk when they're doing business with counterparties that they don't know real well, so letters of credit and things of that nature. And as you know, it would be no surprise to anyone in the room, the trade between U.S. and Europe has been developed for a long, long time. So that trade tends to be on open account terms, at least historically. Wire transfers back and forth, just open account, net 30, 45-day terms. So typically from a banking standpoint, there's not a whole lot that we tend to get involved in, except when the financial crisis happened, you know, right after, you can almost pinpoint it to when Lehman Brothers failed in the fall of 2008. That first half of 2009, world trade, for the most part, and the other international bankers in the room might agree with this, really came to a stop. A lot of the trade that had been on open account previously, customers here that were selling to Europe were asking for letters of credit from their customers, and banks, for the most part, were unwilling to confirm those letters of credit because we didn't know kind of what exposure those issuing banks might have had to other banks and the domino effect that might have happened. So generally what we saw was a movement away from what has historically been the open account business between the counterparties to a move to letters of credit and stuff to help mitigate that risk. I'm happy to say that that is starting to loosen up some, and there's kind of a trend back towards more open account business with, you know, their established customers and stuff. Just by way of some statistics, the trade between the U.S. and Europe is 1/3 of the entire world trade between all countries. And the foreign direct investment that takes place between the two countries represents half of world GDP. So the U.S. exports to Europe are 3 times bigger than U.S. exports to China. So for all the talk about business in China and opportunities there, the trade with Europe is 3 times larger. So I would say, just in conclusion, that, you know, we saw some, with the financial crisis, kind of a movement towards trying to mitigate that risk, and then luckily over this last really year to 18 months, we've seen that kind of going back to more normal trade terms with our clients.
And Brian, just to follow up, as to U.S. Bank, would you say today the bank's a little more willing to lend on European trade than it was, say, 3.5 years ago?
Very much so, very much so. And you know, to the extent that there are still letter of credit terms, what we're seeing is that, you know, because of the financial crisis, which is still, you know, kind of in fits and starts, kind of here again, off again, whenever things flare up, we tend to get requests from our customers who are getting requests from their clients overseas to extend terms, so say from 45 days to 180-day terms, and we're able to do that by using letters of credit and stuff, and allowing our clients to, when they ship, get paid immediately, and then provide 180-day terms where the banks are taking, in this case U.S. Bank, is taking the risk that the foreign bank will pay, you know, in 6 months. So it is getting much better. There's still some pushing out of the terms, but I think in general it's safe to say that the trade is starting to normalize.
Thanks. Well, let's add in the logistical side of this. DHL, of course, has its great hub here, and we're grateful for that, and it's growing and doing well. We have Joe Yingst with us from DHL. What are you seeing? What thoughts do you offer?
Well, first, I think it's important that I explain where logistics falls into this piece of the puzzle, and I've gotten very good at this, trying to explain to my parents for the last 20 years what I do, because they really don't get it. But logistics and trade, and DHL's part of that. I think very simply, our job is to enable, to connect people that would ultimately improve their lives, connect business so they have that shared labor to reduce their costs, so that money can be used for other investments, so simply they can afford other things. So, each year we look at a connectedness index where we think that globalization, if you will go. I think we all think we're more global now than we ever have been. But we look at things, as our keynote speaker said, the movement of people. We look at capital. We look at information flow. And then, of course, we look at trade. So every year when I have the opportunity to speak at symposiums and seminars, I seem to always say the same thing, in that I'm very hopeful that we will be more connected in this year than we were last. Statistically, I don't want to get into a whole lot of statistics. We've had a lot of that. But I do rely on the WTO and what their forecast is for 2013. They've scaled that back this year. Globally, trade is expected to grow somewhere around 4.5% to 5%. I think specifically for Cincinnati, I'm a little more hopeful for that, really for the sheer fact that we're really fortunate in a lot of ways this year of our traditional automotive sector in this area, particularly German automotive component manufacturers. Here in northern Kentucky, we have Mobile, we have ZF. On the Ohio side, we have ThyssenKrupp. Car sales were very strong last year. They're expected to be very strong this year. The average age of a car is 10 years old, including mine. So I'm in the market. So I think that sector is going to bode very well, particularly on the import side. I think for those, if we have any exporters out here, I've seen some names, the ocean freight carriers have struggled to find some equilibrium in equipment really everywhere in the United States. For us at DHL, it's easy. If a plane isn't working in Oklahoma City, we just take the plane out and stick it somewhere else. The ocean freight guys, it's tough. When you're sailing a 75,000 TEU vessel, you can't just really jerk it out of one trade lane and throw it somewhere else. Same way with your inland ports. You can't move these huge boxes around very easily. So I think this year the import side will be a bit stronger than what the WTO is expecting. I think that will bode well for you exporters, because you're going to have the equipment, which has been a struggle for a number of years in Cincinnati on the outbound side, to have that equipment to move. So in summary, it's difficult for us to influence. We're an enabler. I think for Transatlantic, there's a lot of talk in regard to European free trade. I've spoke with someone from the Ohio State that's looking into that. There's been a lot of talk about that. I think 2013 will again be a lot of talk about that. I think also maybe for Europe, let's not forget what Deng Xiaoping did 30 years ago in Shenzhen with setting up special economic zones. The Shenzhen model in China really 30 years ago birthed the economic powerhouse that China has been for many years. I think that's a valid consideration for some of these countries that we've heard about, Greece, Spain, Italy. So by and large, in summary, I think Cincinnati, our trade lane, will bode a little bit better, maybe statistically, than others, and I think there is valid considerations going forward on those free trade agreements and special economic zones in Europe.
Thank you, Joe, very much. We'll add in Kai Bitter now. Kai is both a German and a U.S. lawyer with the firm of Frost Brown Todd. Kai, you have a couple of thoughts to offer here.
Yeah, I started practicing in Germany, and now I'm with Frost here. And so I work a lot with inbound, outbound between the U.S. and Europe overall, mainly Germany, but really all over Europe. And there are two trends that I perceive as very positive. One is fracking. there are going to be very substantial investments in this region, multi-billion-dollar investments that will be, to no surprise, a significant game changer for our region. But it's interesting how it affects the trade. When you talk to petrochemical companies, both in the US and also in Europe, about fracking in the US, then companies that before were thinking about investing in the Middle East, specifically Saudi Arabia, that's now ramping up production, trying to attract production in the Middle East, they're now thinking about coming to the Midwest, which is a great development, especially because it's becoming harder and harder for this industry to survive in Europe, with increasing raw material prices and increasing energy costs. So having these manufacturing sites in the US will certainly affect the trade imbalance, the trade volume. But it's interesting how that is perceived also outside of the US. When you read how China perceives fracking in the US, it's quite interesting, because the US has historically used its military, for example, to protect its trade routes throughout the world, and has done a very good job to the benefit of many other countries, including China. They get their crude oil also from the Middle East, and they benefit from the protection that the US military affords. And there is a lot of concern that the US will change its focus if it becomes an oil exporter and no longer really needs the Middle East, for example, for resources. So there is a lot of focus outside of the US on fracking and how it will affect trade volumes, trade routes. The other thing that is very positive is one of the biggest challenges that multinationals and small companies have had between Europe and the US is the difference in the regulatory schemes. There are significant differences in how chemicals are regulated, accounting rules, food traceability, product marking, product approval. And if you talk to a small company exporting to Europe, they don't really know how to do it, and they use service providers here that don't really know it either for their CE marks. You talk to multinationals that think that the EU actually made things worse, not better, in the EU. And with the discussion of the free trade agreement between Europe and the US, for the first time, and I'm sure Elizabeth has seen it a lot more than I have, but for the first time I perceive that there is a real concerted effort to talk about harmonization between the regulatory schemes between the two continents. And that would facilitate, in my view, the trade between the two continents more than a reduction in tariffs, for example.
Very good. Now we're going to add in the views of two very transatlantic companies. Glenn Gertzen is with Pilot Chemical, so he has to deal with REACH and EU regulations and all the Euro issues and so on. So Glenn, what's your take on this subject?
That was like a fantastic lead-in for a lot of the things that we're involved in, oil and gas and what's happened in the last 5 years, not just fracking, but enhanced oil recovery and repressurization of a lot of those wells has been a boon to the petrochemical industry, which has made us, given us a renewed competitiveness on a lot of our feedstocks. Just simply couldn't compete with the Middle East, Europe, or any place else. So we were bringing feedstocks in. We're starting to see some of those feedstocks being available, people reinvesting in the Gulf Coast, which is a boon to us. We're seeing some of the projects that are down there that are going to make the U.S. competitive in those markets for a long time. You know, we're talking about REACH and some of these regulatory things. We're a fairly small company. Those have actually been a plus for us for exactly the reasons that were described here, and that there's at least one set of standards that we have to comply with in Europe rather than 20 standards that we have to. So I think our keynote speaker was talking about integration versus disintegration. That would be, disintegration would be terrible for people like ourselves, and that while some of these things are onerous to comply with, been a huge plus for us, and that as a small company we could understand one set of standards. So I think those pieces, you know, kind of piggybacking here off of one of my fellow panelists, are a big plus for us. These are positive years for us in Europe.
And we'll end with Jennifer Warner. Jennifer is with Data Alliance, not a manufacturer in the services business, so another take on it with presence in both continents. Jennifer, your thoughts, please.
The biggest takeaway that I would have is Data Alliance is an application service provider of VMI. So what that means in plain terms is we manage manufacturers' inventory down at the location level for their locations and their products. So we had a lot of you in here are European manufacturers. We have a lot of European manufacturers who are clients, and they said, you know, can you bring this to Europe for us? Can you bring the customer service that we're getting over here in the US to Europe? And so we said yes. And I think the biggest takeaway that I would have from an economic perspective is you're going to go where your business makes sense. It made sense for us to go ahead and open an office in Europe. The fact that there's a lot of standards that are similar between Europe and us was a big boon for us. It's been a challenge to get the office up in Europe. I think it would have been an even greater challenge if we were dealing with 15 different currencies and 15 different sets of regulations. But I really think that you're going to go, and I think Pilot would say the same thing, you're going to go where your customers want you to go. You're going to go and you'll work your way through all of the economic stuff that comes up out of that.
For both Glenn and Jennifer, continued expansion this year and next with Europe or not?
For us, definitely. I mean, we're pretty new to Belgium. We opened our office in July. We have 2 employees that are going to be starting to do our customer service work for us in February. So yeah, I mean, expansion is kind of is going to have to happen for us, right? But we have a lot of interest. We have a lot of customers who say, I want to help streamline my processes just like we do in the US. I want to have a better relationship with the customers that I have, their downline customers. So we manage everything from DVDs to wire and cable to socks to yogurt. So, you know, and they're saying it's the relationship that I have with my location, my stores, my retail outlets, my distributors, that is very important to me. And I think that's kind of it's a universal theme. It doesn't matter whether you're a North American company or you're a European company. You know, you want to strengthen those relationships as much as you can. So yeah, we definitely see a lot of growth potential.
You're bullish on Europe, Glenn? What's your 2-year projection?
I think we'll see expansion as well, but I think for us it will be market share expansion rather than really organic growth that's happening over there. We're finding a path to be able to compete and understanding the market, and that's giving us opportunities to not just follow our customers, but to find new customers.
Very good. Well, it's about 8 minutes now for the audience. So comments, questions, you have before you little things you can push if you want to talk into them so you can be heard. So, your turn. On trade. We'll follow with an investment panel. Who wants to go first? Yes. Joe. Push your little thing there.
For our keynote, I'm in the banking industry, and our bank itself and a lot of the U.S. banks have been very focused on Basel III coming up 2019, trying to get prepared for it in 2013 and 14. Where are the European banks positioned? And when I think about their balance sheets, I know I generally think they're more laden with government debt, that sort of thing. And how does all that play into the capital requirements that are going to be coming forward with Basel III, and particularly with the banks in Europe?
I would say if you look at the financial industry in general, most of the banks are not yet where it should be in terms of the Basel III requirement, but this is true both for the US and for Europe. I don't see big differences here. We are currently obviously focusing more on Europe because we have the euro crisis ongoing, but I think also here there's still a lot of toxic assets on the balance sheet at this stage. One country which is complying very fast with it is Switzerland. Interestingly enough, we have all these two big Swiss banks. So my bank, as well as our biggest competitor in Switzerland, which is Credit Suisse, not to name it. We are complied to be faster in terms of Basel III, and on the top of that, the Swiss authorities have put a Swiss finish, meaning that we have even more tougher rules than everyone else has currently. And this has to do with the fact that Switzerland doesn't want again to be put into the problems that they're facing 2008. Back then, the balance sheet of UBS was 5 times as large as the Swiss GDP. So it tells you that this is a big problem for a tiny country like Switzerland to have those two big banks here.
Yes.
This is also a question for Andreas. You painted some not so rosy pictures and so forth for Europe. Growth can mitigate a lot of those things. What do you see as the growth potential in Europe, and what could either improve it or detract from it?
Everyone hear the question? Good.
So the growth potential in Europe is lower than the one of the US, plain and simply due to demographics already. You have some of the more important countries like Germany or Italy, which will have shrinking population going forward. Other countries have better demographics, like France, for example, Sweden or the UK, so they will continue to increase their population. But one can say safely that the growth rate of GDP, even if we come back out of all the troubles, will be probably lower, also in the long run, than the one of the US because of the demographics already. The second thing we have to acknowledge is that Europe currently is going a different way in terms of bringing back the house into order than the US is doing at this stage. And this goes into this debate which was launched by the new French president. Do we need austerity or do we need growth ultimately? And if we have growth, probably the problem will be solved by themselves. I'm personally, despite the fact that I was raised up as a Keynesian, I'm personally in the camp of the people who think that austerity is probably the best thing to do ultimately. And this goes back to the experience through which the emerging market went in the 80s, 90s. They had the similar debt problems we have now in the Western world. That on average, a debt to GDP ratio which was way beyond 100%, and we have it now. If we look at the G7, it's way beyond 100%. And so many things were done back then, like, for example, printing money. Things we're doing here in the US at a very large scale. It's also done in the UK. Countries were defaulting. Greece has done it. Probably other European countries will, maybe Portugal will have to do it at some stage. All this led nowhere. And if we look, the only way to really come out in the long run and to have, again, sound growth was done after the Asian crisis by many of those Southeast Asian countries who really went through several years of hardship by just bringing back their house into order. And this is why I'm concerned about Europe in the short run, and I'm concerned that probably this German way, if Germany wants to push it through the whole of Europe, they maybe not achieve it, and ultimately this will put a lot of stress on the euro. But if they achieve it, Europe will be in much better shape than at some stage the US, who is just continuing to kick the can down the road. And probably we will have a debt ceiling debate again in 2 years from now, and then again in 4 years from now. And when the debt to GDP ratio is at 150%, probably we'll start to think maybe now it's time to go for quantitative easing 8. And I don't think this is the way to solve a problem ultimately. It goes through the fact that we need to acknowledge that over the last 20 years, the Western world has lived above its means, and now it's payback time, and we need to pay the bill at some stage.
Well, that's a direct lead into our investment panel, so let's thank our trade panelists very much, and ask the investment panelists to come down and bring your cards here. And Andreas, if you'd stay with us, appreciate that, and we'll move into the investment panel. And this is the focus on European investment into our region. How is that going? Is it up, down, sideways, continuing? as I think everybody in this audience knows, there's a tremendous amount of European company investment in our region. And many of the companies here represent that. And so that's what we want to discuss here in the next concluding half hour. And we'll have about 10 minutes at the end, as we just did, for you all to make your own comments and ask questions. So if we're settled in there, we're going to start with Bob Bradley. Bob's with Bannockburn Forex business. And Bob, what's your overall economic trend outlook that we should know?
Thanks, Joe. The graph that we just put up goes back to the creation of the euro in 1999, and I thought that'd be a good place to start. Back then, I did a series of presentations, how the euro came about, the criteria for admission, and then also the kind of what I thought was going to happen for the future, the longevity and durability. And when we look at the graph now, we had a little bit of each. I call it the good, the bad, and the ugly as the title of the presentation. And then 13 years later, we can look at that graph and see that we've had a little bit of each of those. Now, I'd call your attention to the 2010 to 2012 period of time that Andreas kind of talked about before, the European crisis. And what's interesting to note as we look at the graph is there's a period of time where we tested 120 as the low for the dollar or for the euro. And that's well shy of the 80 cents that we saw back in 2001. So the circumstances certainly now differ than in 2001, but nonetheless the story is we are nowhere near the ultimate lows that we had posted for the euro. Now, going to the next graph, we have the euro area growth rate as well as the United States. And as we see, you've got a little bit of a difference in each. And a lot of times it calls me back to my foreign exchange beginnings, where there's a couple of philosophies or statements that we kind of live by, one of which is you never fight the Fed. Now, in these circumstances, as Andreas mentioned, the central banks, very much the Fed included, have done a historic easing of monetary policy. And like I said, it's not just the Fed, it's several central banks all at the same time. The idea is to create economic growth. But, you know, that fighting the Fed is something that you don't do. That's kind of the message that I have. Ultimately, the Fed has, and other central banks have the tools by which to engineer faster economic growth. And I believe that will be the case this time around as well. Now, looking at the United States, we're bordering on a 3% growth rate. So that's very much better than Europe currently, which is fighting at a 0% growth rate currently. But the trends are up in each, which is the next kind of tenet of foreign exchange. The trend is your friend. So here, in each case, growth is improving. It's improving faster in the US, and I think that bodes well for 2013 and then even 2014. Europe, on the other hand, it's a slow growth picture. It's a fight to get above zero. I think the prediction is that we will have a negative growth rate for the Eurozone this year, but a recovery toward the latter part and then a positive number as we step into 2014.
And briefly, from a Forex perspective, your projections for this year, what should companies be thinking about?
Well, for the euro, my prediction is that we will spend most of 2013 between 130 and 140. Now, it's kind of easy prediction to make. We're right in the middle of that range today. I think 134.50 is the rate this morning. So I believe we will spend most of our time between those two numbers. If I were to get